Hello, my name is Kevin Johnson here at One Blue Real Estate School. Thank you so much for joining us here for Episode 3, State Transfer Taxes. Now, if you're studying for your sales pre-license exam, this is some math from Unit 14, so I hope this will be helpful for you. So let's jump right into it. One of the first things I want to talk about when we're looking at state transfer taxes is what are we doing, right? Because that helps us to clear up why we're doing what we're doing when it comes to the math. So the first thing we're talking about here is the transfer of property from the grantor to the grantee, from the seller to the buyer. In order to do that, we have a couple documents potentially that need to be recorded. Of course, the first one, any sale, we have to record the deed. That's going to be part of the property transfer side of this. So typically a general warranty deed, but any of the deeds that transfer ownership. Remember, title signifies ownership, deed is that transfer vehicle. It's what we put the title in to take it from the seller to the buyer. And we have to pay a state documentary stamp tax on that. We also, if we have financing involved, we have what's called the promissory note. So if you remember from class, that is the document that promises that the borrower is going to repay the lender the money that they have borrowed. And the last document that we potentially have to have recorded, if there's going to be financing involved, is the mortgage lien itself. And we're going to pay an intangible tax on that. So we have a documentary stamp tax that we have to calculate for the recording of the deed, a documentary stamp tax for the recording of the note, and then we have what's called the intangible tax when we record our mortgage lien. So let's take a look. The state documentary stamp tax on the deed, we have the state documentary stamp tax on the promissory note, and the intangible tax on the mortgage lien. The deed is calculated using the sale price of the purchase. So whatever we're selling for, that's 70 cents per 100. For our promissory notes, that we're going to record any new or assumed promissory notes. That's calculated using the loan amount for each of the loans if there is a new and an assumed. Remember, if we're assuming the seller's mortgage, we need to record a new promissory note so that the public gets constructive notice as to who owes the money. That is 35 cents per 100. And last, we have the intangible tax. We're calculating using the loan amount, and this only applies on new mortgages. Why? Why is it only on new where this one's on both? Remember, a mortgage is a lien, so we give a mortgage to the bank as a borrower. If there is a mortgage lien already for an assumed loan, the lien is against the property, not against the person. So we don't have to record a new one if there is an assumed loan. We only record a new mortgage lien on new loans. Hope that clears up a little bit for you there. So the documentary stamp tax is a state tax associated with the recording of the deed or other documents to give constructive notice. Now, there also may be some county recording fees, but we don't test on that. The number of doc stamps that we're going to need is going to depend on the value of the document we're recording. We simply divide the value of the document by 100 to find out how many stamps we need. Here's an example. Let's just say we have a deed, and that deed was for $1,000. How many stamps do we need? We take the sale price of $1,000, we divide it by 100, and that's going to tell us that we need 10 stamps. Now, the doc stamp on a deed is 70 cents, so we take that 10 stamps that we need, multiply it by 0.70, and if this was a real property, it would cost us $7 to record that deed. Now, we also need to note that you cannot purchase or use a partial stamp. So what happens if you have a fraction of a stamp? So let's take a same deed. Now we're looking at $1,250. When we divide that by 100, well, we're left with a problem. We need 12 and a half stamps. Unfortunately, we can't have that half a stamp. So in that case, we have to buy a whole new stamp because we always need full stamps. So if you ever, even if it's 0.1, if it comes back that you need 12.1 stamps, you would need to go ahead and get a full additional stamp. In this case, 13 stamps times that 0.7 would give us $9.10. All right? So now that I've kind of explained the why behind the doc stamps, let's take a look at a couple examples. What I'm going to do is we're going to work all three documents. I'm going to show you an example of a doc stamp on the deed and then let you practice one. I'm going to show you an example for the note and we'll let you practice one. And then we'll do an intangible tax and then we'll let you practice one. Once we've done all three steps individually, the last question I'll give you is everything in one. So let's dive on into it. Let's talk about the documentary stamp tax on the deed. Now, we have a home that sells for $150,025. How much are the doc stamps on the deed? All we do is take our purchase price, we're going to divide it by 100, and that tells us we need 1,500.25 stamps. Can't have a quarter stamp, so we have to round up. We need to purchase 1,501 stamps. How much do those stamps cost? For the deed, 70 cents. So 1,501 stamps times 0.70 gives me a doc stamp of $1,050.70. That's the stamp tax, nothing else. Don't round it, that is just all there is. So that's an example for the doc stamp on the deed. Remember, on the purchase price and the tax is 0.70. Now, why don't you give it a try? A home sells for $216,293. How much are those doc stamps? Hit pause, and when you have the answer, hit play, and we'll check your work. Welcome back. So what did you get? Let's take a look and check your work. Purchase price of $216,293. Dividing that by 100 tells us we need 2,162.93 stamps. I can't have a partial stamp, so I have to round that up to 2,163 stamps. We multiply that by the cost of the stamp. Our price is $1,514.10. That's doc stamps on the deed. Did you get it? Awesome. Let's take a look at documentary stamp taxes on the note. Now we're changing the price, but we're not going to change the process. Instead of 0.7, we now use 0.35. A buyer purchases a property by assuming an existing loan of $62,350 and signing a new mortgage and note for $110,052. Now, one pro tip here for you. We're never going to add them together at the beginning. We just only add them at the end. I'll show you what I'm talking about because that could lead us into some trouble. First, let's take our existing loan. Our existing loan is $62,350. Divide that by 100. That gives me 623 and a half stamps. I can't have a half a stamp, so I have to round it up to 624 stamps. Multiplying that by 0.35 gives me $218.40. Now, let's take the new one. The new mortgage was $110,052. We divide that by 100 to find out we need 1,100.52 stamps. Yep, I have to round that up again. I need 1,101 stamps times 0.35 per stamp gives me $385.35. So our combined documentary stamp tax on the financing for this transaction is $603.75. All right, now it's your turn. Let's give it a try. A buyer purchases a property by assuming an existing loan of $57,000 and signing a new mortgage and note of $163,523. What are the doc stamps associated with recording both of these promissory notes in the county records? Hit pause, give it a try, and when you think you have your answer, hit play, and we'll take a look. Welcome back. What did you get? Let's check the work. The existing loan, $57,000 divided by 100, 570 stamps. Don't have to round on this one. Multiply it by 0.35, which is the cost of the stamp. $199.50 is our doc stamp tax. For the new mortgage note, $163,523 divided by 100 gives me 1,635.23 stamps. Have to round that one to 1636. Multiplying that by 0.35, the cost of the stamp, my documentary stamp tax, $572.60. Add them together, my total, $772.10. All right, so now we've done the documentary stamp tax on the deed. We've done the documentary stamp tax on the note. Now let's take a look at the intangible tax. Now this one, uber complicated. Complex formula. You might need lots of scratch paper. All right, we take our question from before. Buyer is purchasing a property by assuming an existing loan of $62,350 and signing a new mortgage and note for $110,100. Remember, the existing one we don't have to worry about. That lien already exists. And the intangible tax is for the mortgage lien. So we only need to worry about this $110,000, the new one. So here's my complex math formula. 110,000 times 0.002 equals done. I was joking. Very simple formula. This is the only one of the three that's different. That's our tax, $220. You ready to give it a try? Remember, it's 0.002 and only on new mortgages. Buyer purchase a property by assuming an existing loan of $71,900 and signing a new mortgage and note of $150,000. What is the state intangible tax on the mortgage? Hit pause when you think you have your answer. Hit play. We'll check your work. Welcome back. Have an answer? Let's take a look. Which one do we use? The $71,009 or the $150,000? If you said the $150,000, you're smart. Times 0.002, $300 intangible tax. Bada bing, bada bang, bada boom. We're done. All right? So that is all three steps that you have to worry about. Now, unfortunately, they're not going to give it to you this easy, more than likely, on the state exam. You're going to have to kind of put some stuff together. So let's take a look at a challenging potential state exam question. Susie and Mike recently bought a home. They paid $4,500 in closing cost. They put down $50,000 in cash. They obtained a new FHA loan for $150,000 and assumed the seller's VA loan of $50,000. What are the total transfer taxes associated with this transaction? That means everything. Remember, you're going to need three things, so we put this here to help you remember. Hit pause, work on the problem, do your best, and when you're ready to check your work, hit play. Welcome back. Let's see how you did. First, let's check these numbers. What did you get for the purchase price? Did you get $200,000 or did you get $250,000? Remember, our purchase price is our financing, so the $50,000 and the $150,000 plus the cash that the buyer is putting down. The closing cost was put in there to see what you would do with it. You don't need to do anything with it. Our new loan is $150,000 and our assumed loan is $50,000. So now that we have these three numbers, we can do some math. I've put them across the top and we're going to work down from here. Our doc stamps on the deed, $250,000. We're going to divide that by 100 to get 2,500 stamps. Multiplying that by 0.7 gives me my doc stamp tax of $1,750. My new loan, the doc stamps on that note, we're looking at $150,000. Divide that by 100. That's 1,500 stamps times 35 cents. Gives me $525. Let's go ahead and get the doc stamps done on the assumed. Let's take a look. 50,000 divided by 100. 500 stamps times 0.35. That gives me $175 doc stamp tax on the assumed loan. Now we have to do our intangible tax. So which one does it go under? The new or the assumed? It goes under the new and the new only. So we just take our loan amount, multiply that by 0.002. That gives me a $300 intangible tax. So the total state transfer taxes is all three. We added all up, $2,750. That is the total transfer taxes for this purchase. Well, how did you do? Did you get it? If not, don't worry. We offer lots of practice online. Go to our website, onebluerealestateschool.com, and you can click on study resources at the top. We do have a math tutorial video there as well. Also, check out our exam prep dates. Maybe coming in and spending a weekend with us to kind of refresh on the topics will help you get ready for that state exam. Thank you so much for watching, and be sure to check out our other From the Classroom videos right here on our YouTube channel or on Facebook.